Thanks very much, Neil. So let's begin by talking about quarter three in the portfolio. Portfolio unfortunately produced a negative return over the quarter, driven by the portfolio's overseas bond allocation and domestic equity allocation. Overseas bonds and US bonds were both negative, but the allocations outperformed the broader indices of those asset classes. Overseas equities slightly detracted, but outperformed the broader index. And hedging of the Australian dollar was a small contributor given the depreciation of the Aussie over the quarter. So whilst in an absolute sense returns across our universe of investments were negative over the quarter across all of the different asset classes, our investment decision making added value both in the allocation to short duration bonds, which outperformed the equity indices, as well as the broader bond indices, as well also as in stock picking outside of the US. It was only in US stock selection that we underperformed versus an index comparison. In the US, the stock market had a volatile period as inflation data continued to fall, but remained above the targets, and other US economic data remained strong, indicating that the Federal Reserve would need to keep rates higher for longer, and that disappointed many investors who'd been looking for interest rate cuts to start coming through early in 2024. In the US, sectors such as energy, driven by the strong oil price, and financials stabilizing after a weak first half of the year led the market. The utility sector lagged the market as higher yielding utility stocks and REITs competed with government bonds now for investor monies. It's a long time since that's been the case. The portfolio benefited from having an underweight position in the utility and REITs sector. However, the companies that we held that were behind the index over the quarter included Lockheed Martin and American Express. Lockheed Martin was impacted by concerns about the US government shutdown. It's worth noting, however, that that was always a worst case scenario for the company that doesn't drive all its revenues from the US. American Express was impacted by concerns about how a slowing economy, slowed down by the higher rates, would impact delinquencies. But given American Express's customer base is amongst the most affluent in the country, we're confident that any uptick will only be a short-term headwind. Some of the better performing companies in the portfolio outside of the US included Telenor in Norway and Imperial Oil. Telenor offers telecom services across the Nordic region as well as in several Asian countries as well. Their shares were pretty weak in quarter two of this year, but then recovered during the third quarter as the company announced much stronger results that beat expectations and showed strong growth in the Nordic region as well as in several of the Asian countries. Colleague met with the CEO of Telenor during the quarter, and he made the observation, or reiterated the observation, that the sector really needs to see consolidation. There's too much competition in telephony, particularly mobile services, in many jurisdictions. And whilst regulators have recognised that, or started to recognise that in Asia and allowed consolidation, that really needs to happen in Europe as well. And we're hopeful, although only cautiously hopeful, that that will start to be recognised. The bond allocation, moving to that, detracted over the period. Overseas bonds slightly outperforming US bonds, and the contribution from overseas bonds was aided by the appreciation principally of the British pound and the Canadian dollar relative to the US dollar. The Australian dollar is the only currency that we have hedged, and that weakened slightly against the US dollar, so there was a positive contribution from that. We think the US dollar is pretty much the most expensive currency on the planet at the moment. We have a significant 45% exposure to non-US dollar assets. And so if that overvaluation corrects, which we expect it to over time, the portfolio will benefit from that. Moving to some comments about the 12-month period. In many ways, this is the opposite of the 3-month result. In the absolute returns, we're pretty strong, but the relative returns don't look as good. It's our low weight in equities which significantly outperformed bonds that wasn't helpful, and our performance in each of the equity categories was also relatively negative. But our defensive approach typically leads to underperformance in periods when equity markets perform strongly, and going up over 20% in a year is certainly performing strongly. The bond performance did, however, materially outperform the indices due to the lower duration versus that of the benchmark. So turning to portfolio positioning, there weren't any significant changes to positioning over the quarter. Allocation still just under 80% bonds, 20% equities, and 2% cash. The fixed income allocation defensive during the quarter with a very low modified duration, around 2.2 years. And the equity portfolio dominated by what we regard as defensive names that we would expect to outperform during volatile periods. The focus of our approach is identifying companies with strong balance sheets. The debt equity ratio of the stocks in our portfolio are much lower than the benchmark, and in an environment where the cost of that debt for many companies is going to be a significant headwind to earnings, we hope that the stocks we hold will be insulated from that. In fact, a number of the companies that we hold in the portfolio actually have cash on their balance sheet, so rising interest rates are a support to their earnings rather than a headwind to it. Within Europe, there's no holdings in the peripheral Eurozone, where sovereign debt concerns haven't really been eradicated, still questions needing to be answered by governments there. We're concentrated in Switzerland and the relatively healthy economies of core Europe and the UK. In Asia, we remain focused on Southeast Asia over Japan, and in places like Australia and Taiwan too, where potential economic growth, levels of debt, and frankly valuations are more attractive than we can find in many places, including the US. There was no change to the hedging position of the portfolio as I described. Were some stock changes. So a new purchase during the quarter, a company called Steel Dynamics, which was funded by reducing Rockwell Automation's position in the portfolio. Steel Dynamics operates as a steel producer and a metal recycler in the US. Steel operations, recycling, and steel fabrication, significant export exposure, and trading now at what we think is very attractive valuations. So turning now to talk a little about the outlook. It seems, and this relates to my title of this presentation, The Eye of the Storm, that the realities of higher interest rates for longer are now settling in. For 40 years, bonds have been in a bull market, central banks coming to the rescue any time that looked like we're reversing, but the return of inflation, unexpected by many central banks, has given them and everyone else a fright, and there seems to be a significant commitment to eradicate that. But it's going to take time, and there are still pressures coming through. The inflation story, inflation data releases are keenly anticipated, but don't yet present a clear picture of the corner being turned. So with that in mind, whilst we think there's still some way to go with dealing with that and with bond yields. We do recognise that they have increased significantly. The chart we're looking at now shows real bond yields in three major bond markets, the yield after inflation. And after these fell sharply negative when inflation returned end of 2021, 2022, they have now started to go back in the right direction. And in recognition of that, we have started to increase the duration of the portfolio. So this didn't apply in Q3, but a couple of weeks ago, we increased the target for duration in the fixed income portfolio to 5 years. So still pretty conservative. It's not suggesting that we think yields can't go any higher than here, but it's recognizing that the risks are more balanced now. This is a chart showing the inflation components in the US. And whilst the goods products that were in short supply and hence seeing price pressure, durables and non-durables, have started to fall significantly, services inflation, which is 60% of the total, is still pretty robust. So this isn't going to go away overnight, and central bankers certainly seem committed to dealing with it. Similar story here. Bond yields starting to increase, but probably some further to go. This is one of the charts which we think it's worth keeping an eye on. The return of inflation has empowered unions in markets where they're still significant to do their job and demand better rewards for employees. For many, many years, employee compensation as a percentage of company revenues, here shown in the US, but this chart would apply in many other places as well, fell significantly. Now, with shortages of labour and a return of inflation, I think it's reasonable to expect that this chart will be pushing back upwards, and that's a pressure on company earnings and a pressure therefore on valuations of companies, which isn't reflected here. And this is behind our caution on the US equity market. This well-known series, the cyclically adjusted PE, tries to smooth out the effects of an economic cycle on companies' earnings. So it takes the average earnings over a 10-year cycle, compares with the valuation of the stock market. And whilst it's some way off its peaks, it's still significantly above its long-term average. And as households, companies adjust to higher interest rates and employees demand better rewards, earnings which are behind this chart, we think will be under pressure, and that isn't reflected in the valuation of the US equity market. One of the helpful release valves for inflation over the last 30 or so years has been deflation exported from China, driven by an expanding labour force. This chart, however, shows that those days are over. The labour force, working age population, is shrinking in China and will continue to for many years. Fewer people working every day means that there aren't multiple applicants for job vacancies, and wages need to attract people, which I think is something that will be felt a long way from China for quite some time to come. So the eye of the storm, markets have been relatively subdued over the last few months, adjusting to the volatility that we saw last year and certainly the year before, a very rapid increase in interest rates. But is that the calm passing overhead? Are we about to head into a period of heightened volatility? There's certainly a chance of that. The adjustments that households and companies need to make to interest suddenly being a significant expense, having had for so long it not being anything really at all on a company income statement, it's going to take a long time to adjust. The adjustment for households of mortgage costs still isn't being fully felt because of the effect of fixed rates in many major markets. So we think there's a good chance of volatility ahead. We want to remain conservatively positioned to ride that out and try and repeat the low downside capture and the lack of volatility, which is the target of this portfolio. So I hope that's been helpful. Please reach out if you have any further queries, but I'll stop there. Thanks, Anil.